This is a short introduction to Chapter 3, the adjusting process. We're adjusting the books before we issue financial statements, and this is largely a result of using the accrual basis accounting. That's what this course is about. Generally accepted accounting principles is about accrual basis accounting, not cash basis. Cash basis waits until cash is received, until revenues are recognized or cash is paid, expenses are recognized. We're not interested in cash basis but accrual basis accounting. That is, recording revenues in the period in which they're earned and recording expenses which were incurred, giving rise to revenues. In effect, the matching principle in accounting. So we're making adjusting journal entries in this chapter that are needed before financial statements are pulled off, let's say each month or each quarter. Why? Unless these are made, those financial statements will not be representative, not be accurate. Again, the why is because some events occur before cash moves in and out. So we need to accrue or book either a revenue or an expense before cash moves in certain circumstances. So we're going to make some accrual adjustment entries at month end or period end to ensure that either revenue and expense are properly stated. Another reason we do adjusting journal entries is that some events in a company's life are booked, they book cash movements, either in or out, that cash comes in, but the ultimate reason is delayed or deferred. In other words, we had prepayments of revenue from a customer before we performed services, so it was not earned, or we prepaid some expenses 6 months in advance, like paying auto insurance in advance, so that expense belongs to a future period. So whether those are the cases that we make adjusting journal entries, they're called deferrals in your book. And up here indicated called accruals. But both of these are because of the accrual process in accounting. Getting expenses in the period in which they pertain, or getting revenues in the period in which they're earned. They may have been prepaid, we have to adjust for that. Another term used for deferred adjusted journal entries are prepaid. In other words, cash was prepaid by a vendor, not yet earned, and so now we're coming back in a later period and recognizing when it's earned. Or expenses were prepaid, we're coming back in a later period, the current period, and expensing it when it's previously not expensed. This chapter is primarily concerned with getting expenses or revenues right in the correct period. The adjusting journal entries never make an entry to cash. It involves either revenue or expense, and the offset is some asset account or some liability account. So all our adjustments will be either increasing an expense account or increasing a revenue account. Expenses come into being two ways. Either we can book an accrual adjustment, which means creating a new liability before the expense is due. Utilities for the month of February are paid in March, so we book it, the expense in February, we accrue it. Or we can decrease an existing asset as a deferral adjustment and becomes an expense. Likewise, revenues can come into being in two different ways. Either we create a new asset through an accrual adjustment, we do some work for a customer, charge our accounts receivable, recognize revenue one period, collect cash the next, or we decrease an existing liability account, a deferred adjustment. This is a prepaid revenue by a customer not earned to a future period. We come back in the current period and create a revenue by reducing a unearned revenue account. I want to demonstrate some adjusting journal entries using the colors red for debit, black for credit. And you recall in the previous chapter, debits are always positive, credits are always negative, and so we'll use those colorations to describe our adjusting journal entries, two types: accrual adjusting journal entries or deferrals, sometimes called prepaid adjusting journal entries. As a reminder, my use of these debit and credit tokens comes from the reverse number line, which can overlay the equation. The right-hand side, claims against assets, liabilities on equities, are a negative world when populated by credits, and assets are a positive world when populated by debits. And depopulating those two worlds is just the opposite. We credit assets to depopulate them. We debit claims against assets to depopulate or reduce them. So let's look at accrual adjusting journal entries first, where we accrue an expense before it's paid. We book an expense, debit, expense account, which brings down the owner's equity category, and we credit accounts payable, which increases a legal liability. Booking an expense before it's paid at month end to ensure that we have the expense recorded in the proper period. An example of an accrual adjusting journal entry: increasing expenses. The example of an accrual adjusting journal entry that affects revenues, we would example of an adjusting journal entry at month end involving revenue that we book before we receive the cash, such as painting a person's house in February, collecting the bill in March. We would increase our assets, accounts receivable, to debit, and increase our owner's equity with a credit to earned revenue. Again, we were earning it in the period in which the service is performed, not necessarily when cash is received. Accruals never involve the cash account, but always involve either increasing revenue or increasing expense. Revenues are increased with a negative credit because this world over here, both these categories are increased with credits. Now, an example of an adjusting journal entry that's called a deferral or prepaid. These were cash moved previously, and now we're adjusting the effects of that previous cash entry. So, a previous cash entry, let's say we bought some insurance that affected the next 6 months of coverage. We would have debited prepaid insurance, so the adjustment is going to be to credit prepaid insurance, bringing it down, and debit insurance expense under equity, recognizing insurance expense in the period in which it belongs. Again, we're adjusting a previous account that was, in effect, our insurance was prepaid for, let's say, 6 months of future coverage. Now, at the end of a month, we're saying 1/6 of that has to come out of that account, credit it, and put into insurance expense account under owner's equity, debiting it. Increasing expense, adjusting journal entry, deferred entry. We have previously deferred the recognition of expense when it was paid. It went to prepaid insurance. Now we're adjusting that account downward and insurance expense upward, which decreases owner's equity on the right-hand side of the equation. In the example of an adjusting journal entry or deferral or prepaid related to revenue, if a customer pays us in advance, when the cash came in, we can't bring it to regular revenue, but it's an unearned revenue. So a previous transaction would have credited unearned revenue because it was received in the period in which it was not earned. And then at the end of a month, our current month, make an adjusting journal entry, we will decrease unearned revenue with a debit and credit regular revenue under owner's equity, because now in this period we've analyzed that we've completed the service that was previously prepaid but unearned. Now it is earned, and so we debit unearned revenue in the adjusting journal entry at month end and credit regular revenue recognized in the income statement, bringing up owner's equity, decreasing liabilities. So in summary, adjusting journal entries either increase an expense or they increase a revenue account. So in summary, adjusting journal entries either increase an expense or they increase a revenue account. That's our primary target to get the income statement correct. And accrued expenses either are booked by creating a current liability account or by decreasing an asset account and expensing an accrued expenses account are created by debiting an expense account and creating a current liability, accrued expense, or reducing a prepaid insurance account, prepaid asset account, and debiting expense. So adjusting journal entries of the accrual type create an expense by creating a new revenue, crediting accounts payable, debiting expense, or accruing a revenue by increasing an asset, account receivable, crediting revenue. Again, this is the main objective of adjusting journal entries at revenue expense account. And a deferral adjustment entry affecting expense would decrease a prepaid account with a credit debiting expense in the income statement at month end. Or a deferral revenue entry would decrease by a debit a unearned revenue account and offset it with a credit to an earned revenue account in the income statement. Again, at month end, none of these entries that affect expense or revenue, whether accrual, adjusted journal entry, or deferral, affects the cash account. All income statement accounts and offset either an asset or liability in the balance sheet. The primary end game is to get revenues and expenses stated correctly in the period in which they are earned or in which the expense applies, either through accrual entries or deferral adjustment journal entries at month end. Failure to do this would render the financial statements inaccurate if these adjustment journal entries did not occur.